Hi, I'm Charley Farley. I want to thank you for joining us to learn a little bit more about how you can qualify for a mortgage. Mortgage lending. It's actually a really simple business. There are only 4 things that we're going to look at. It's called the 4 C's of mortgage lending. It's collateral, cash, credit, and capacity. As your mortgage lender, my job is to help you to document your loan application to demonstrate that you meet the requirements of whatever program it is that you want to participate in, as the requirements pertain to these 4 things. Let's start out with collateral. Collateral is about the property that you want to purchase, whether it's a single-family home, a condominium, or a 2-family, or even a 3 or 4 family. We need to make sure that the home that you're buying is worth what you're paying for it, that it doesn't have any major safety or health-related hazards, that it's a residential property, and it's marketable. Single-family homes are considered to be the least risky of all, followed by condominiums. 2 families are considered a little bit more risky from a lending standpoint because they statistically default more often, and 3 and 4 families even more so. The second criteria is cash. And the amount of cash that you need really has to do more with the program that you're participating in more than anything else. So if you're a veteran and you're eligible for a VA loan, the down payment requirement is 0. And if you structure the offer that you want to make on the home that you want to purchase properly, the seller can pay the closing costs for you. There are other programs like the FHA program where the down payment requirement is only 2.25%. And then there are conventional loans. They generally work best when you're putting 5% or more down. Ideally, you'd put 20% down on one of those programs, but sometimes 5% or 10% down works equally well. Regardless of the program that you're participating in, the money that you're borrowing is not coming from people who left money in their checking and savings accounts. The money you're borrowing is not coming from a bank. You're borrowing money usually from a quasi-government agency like Fannie Mae or Freddie Mac. They don't print money and they don't get it from the federal government. They sell mortgage-backed securities on the bond market. So stocks and bonds get bought and sold every day. Your mortgage really comes from the sale of a bond. And that's why interest rates can fluctuate from day to day. But that's also why the interest rate from one lender to the next is almost identical from day to day, because they basically all get the same money from the same place each day. The third criteria for getting a mortgage is credit. There are 3 national credit repositories. You may have heard these names before: TransUnion, Experian, Equifax. We would normally order a credit report from a local agency that would get the credit information or data from each of these repositories, merge it into one credit report, and download that to us. It only takes a few moments to get that information, and that information also provides us with a credit score. The score is determined by how much credit history you have, how accurate you've been in paying your bills on time, the number of inquiries, how much available lines of credit you have, and the balances owed on them. We use these credit scores to help determine how low or high a risk you are. The perfect borrower could conceivably score an 849, but anyone in the 700s is considered to have a very good credit score. If you had really terrible credit, you could have a score as low as something in the 400s, but rarely do we see that. So our job is to help you to look at that credit report, make sure it's accurate, help you resolve any issues on it so that you qualify for the mortgage of your choice at the optimum interest rate. The 4th criteria is capacity. That has to do with what do you have for income, what do you have for debt, and what is your capacity to repay more debt like a mortgage payment. Whether you're self-employed or have part-time job income or commission income, we're specialists at determining exactly how much of your income we can use to qualify you for the best possible program at the lowest possible interest rate. Now that you know more about what you need to qualify for a mortgage, you're ready to get pre-approved. And pre-approval is a smart idea. Pre-approval will tell you what programs you qualify for, how much home you can afford, how much cash you need, how much your monthly payment will be, and how much you should ask the seller to pay towards your closing costs to minimize your cash requirements. Thanks for sharing this time with us. Getting pre-approved for a mortgage in New Hampshire is fast, it's easy, and it starts with a phone call. Give me a call at 471-9300 or apply online.
The name to know when you're buying a home, Charley Farley Home Loans.